Did you know that there's a super safe investment that'll give you a 7.12% return on your investment, and it's very safe? Unlike the stock market, which can give you 10% or higher returns on average, but obviously it's very volatile, goes up and down. This one is very safe. So we're going to learn about this investment coming up on Investing Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds interesting to you, go ahead and hit that subscribe button. All right, yeah, a pretty strong, pretty safe, pretty guaranteed rate of 7.12% is very solid, very good. And it's not some kind of crazy, fly by night, rip off thing or whatever. It's actually backed by the most fiscally strong entity in the world. And so we're going to talk about that, and the entity I'm talking about is the US government, and we're going to talk about I-bonds. All right, I'm at the treasurydirect.gov website here where you can actually buy I-bonds and other types of bonds directly from the US government. And I'm going to use this to walk through the I-bonds and kind of talk a little bit about them, how they work, how they're kind of indexed to inflation, how they adjust, and how to get that 7.12% interest rate here that they're going to pay here. And again, when you look at like safe investments, the United States government is one of the, arguably, and is used as the safest type of investment. Why? Obviously, it's the US government. They have taxing authority. They can raise taxes. They can move money around. They have a lot of money. And if it came to it, they can pay their debts. They have a lot of debt, but they can pay their debts. All right, versus, let's say, a company or something else. So 7.12%. So there it is right there. So let's talk about I-bonds, how they work, and whether it might fit for you and your portfolio. So I'll walk through this here. You can tell it's a government website too because it's real small print and got this big blank space here or whatever on the sides, all sorts of stuff. So right now, your 7.12% is through April of 2022. So the thing with I-bonds is that they reset every 6 months. It's tied to inflation. They have a base rate, and then it ties to inflation, or the Consumer Price Index, or CPI. So this is a good thing, especially during inflationary times, where your bonds will reset every 6 months, and then if inflation's higher, your bonds can kind of go up with it. So that's a good thing, where usually bonds will lose value if they're locked in where they're not adjusting. So this is good. Now, if inflation goes down, your interest rate could go down too. But in those periods, like in those 6 months periods, the government will tell you this is what you're earning, is that 7.12%, basically November through April. Now, obviously, we're not in November, so you're going to earn a smaller portion of that because you're going to earn kind of that prorated amount through April, and they'll reset, and then whatever it is in April, that's what you'll earn. And later, I'm going to go and show you what the historical returns are for these I-bonds so you can kind of see, well, is it going to go reset to like 0% or 2%, or could it be higher? I think you'll be pleasantly surprised. So watch to the end for that. So basically, an I-bond is a U.S. savings bond, right? I'm going to scroll down their set here. It's a savings bond that earns interest based on a fixed rate and inflation, right? So that's where it does that. And currently it's at 7.12%. Oh, I can't click on it. 7.12% through April. If you're a United States citizen, is it taxable? Yeah, your profits on it are taxed, but it's exempt from state and local tax. At least that's what it's reporting here on the government website, the federal government website. It's a federal government bond, so that's a good thing. So if you're in a higher tax bracket, like me, I like the idea of something I can at least avoid some taxes on my profits on it. You can buy in either a paper or electronic version. Paper is more nostalgic. I would just always go for the electronic version. Plus, you can get a smaller minimum purchase with the electronic, $25 versus $50. So if you're looking for something that gives you a good return, that's safe, that doesn't cost a lot of money to invest in, you can get started with like as little as $25 with an I-bond. But let's say you want to invest more, you can go electronic. You can go all the way up to $10,000. So you can put in each year. So each year, you can put in $10,000, and then again, your interest rate changes every 6 months, so to keep that clear. If you go electronic. If you go paper, looks like the maximum there is $1,000. I would never go paper, I just go electronic. So I just bought my $10,000 I-bond to lock in that 7.12. For that bond portion of my portfolio, as you know, I'm big in the stocks, crypto, all that stuff. That's the growth part of my portfolio. But if I can lock in a nice little 7.12% and it's going to adjust for inflation, I liked that. So since I'm limited to 10,000 anyways, for me, it's like, okay, I'll do the 10,000. But you can do any increment, smaller increments, just the minimum is $25 electronic. Now, how long do you keep these bonds? Now, am I locked in for 30 years? No, you earn interest for 30 years, all right? So you earn interest for 30 years. So if you want to own it for 30 years, you can. Unless it says here, unless you cash them first, you can basically sell them. So you don't have to own them forever. You could hold them for 5 years, 10 years, shorter periods of time, and then cash them when you need them. Now, if you cash them after 1 year, you can cash them after 1 year. So the rule is you still have to hold it for a year. When you buy new I bonds, so if I just bought I bonds, I need to hold those for a year, and then I could sell them. If I bought I bonds 2 years ago, I could sell those I bonds, but anything new I'm buying, I have to wait a year. But if you cash them in before 5 years, so 5 years is kind of a match number. If you cash them in before 5 years, then you lose the previous 3 months of interest, all right? So if you cash it in before 5 years, whatever your last 3 months interest, you lose that. So a little bit of a penalty there. So they're trying to incent you to at least hold them for 5 years. And you can see they give an example. If you hold it for 18 months, that means you'll get paid on your first 15 months of interest. Okay, thanks government for explaining that to us. It wasn't that high. And then how do you buy them, right? It's easy. You just buy it right through the government site here. You can do payroll direct deposits, or basically you just buy it online. You set up an account and you buy it online, and then you get an account and you can then manage that account from treasurydirect.gov. Once again, this is from the United States Treasury. So a nice deal, right? So let's now look at historical returns of these I bonds so you can kind of get a feel for what they have done in the past, and they'll give you a feel for what they might do in the future. Again, past performance is no guarantee of future results, and they do reset every 6 months. But after a year, you can sell them. If you sell them before 5 years, you have that 3-month interest penalty. So to look at those past numbers, it's a government website, so we have to bury that or hide that. Over on the left-hand side here, under I bonds, there's different products they have, like TIPS, which is inflation-protected securities. So that's another thing as far as something for inflation, but it doesn't pay as well as an I bond. I bonds, we go into rates and terms, and you'll have all this stuff about the different rates and questions they'll answer, and how do my I bonds earn interest, and what interest will I get? Basically the same stuff we saw on that first homepage. Right? That's through April, it's our 7.122. So you got to scroll all the way down. Scroll. I'm scrolling. When does my I bond change rates? That's kind of important to know. So depending on when you're watching this video or when you decide to buy your I bond, you can see based on the month when new rates take effect. So if I'm buying, let's say in January, they would reset every January and July, February and August, and so on, right? So how have the rates been in the past? That's what we're looking for. And they give you all this stuff, and you can look at it on your own, but they look at a fixed rate that's assigned to it. Sometimes that fixed rate, as you can see here, is 0%. Remember, the interest rates are dropping to help stimulate the economy during the COVID pandemic. So the fixed rate went down, but then inflation happened. So the inflation part helped raise that I bonds payment. So you can see the fixed rates are very, very low, from 0 to 0.1 to 0.2, looking over time. If we go now to the inflation rates, you can see where that's raising those numbers up, and it's a combination and some other factors too. So we're going to go where we want to do down to what is the current composite rate? What is the combined rate, and all the things and all the other factors even beyond that they use to set the rate. So that is your rate. That's what the rate you're going to get in terms of interest is. Don't worry about those other things. What you're going to get is that composite rate. That's the one you want to look at. That's the one they have on the homepage. That's what your I bond is for. So as you can see, that's where our 7.12% came from. And you can see it's been 7.12, for November and May, because I'm looking at this November time frame, or is what their current cycle they are in through April, and then it'll reset after that. So once again, if you buy today, it's good through, or if you buy before April, it's going to be good through April, then it'll reset in April. So that's why you're seeing this 7.12%. At these various time periods. But if we go back in time, you can see here, back in 2020 was 7.12, but 2019, 7.33, 2018, 7.64, 7.1 in 2017. We start going back here into like 2009. Remember there was, hiccups and things in the stock market and all that. That's at 7.4, 7.84 in 2008. And they're in the 8s and 10s and 9s when we start going back in 2005 and previous. So I bonds in the end can be a great way to help protect you with inflation a little bit, give you a nice return, especially a nice safe return backed by the US government. So something to consider for that portion of your portfolio where you want to take out a little bit of risk and have a little bit more less risky or more risk-averse type portion of our portfolio. And then, of course, have things that'll do even better than 7% returns, like historically the stock market. And what it looks like, we'll see, cryptocurrency goes way up and way down. But depending when you get in, that could also exceed that. But to be able to lock in something at 7.12 right now, and again, you're going to get a prorated amount of that. It's going to reset in April. It resets every 6 months. And know the rules on the I bonds and when you can sell them after a year, and that you lose your first 3 months if you sell before 5 years. But something that's safe, that can grow, that can get adjusted for inflation. Maybe I bonds has a small portion or has a portion in your portfolio. All right, so check out some of my other videos, hit that subscribe button, and I look forward to seeing you in another video coming up.